Hello, Stock Talk listeners, and welcome back.
Great to be here.
Hey, if you're enjoying these discussions, please do take a second to hit like, maybe share it, definitely subscribe so you catch the next one.
And drop a comment. We do read those.
We absolutely do. Okay, let's get into it. Today we're doing a deep dive into Seth Klarman's Baupost Group.
Yep. Looking at their Q1 2025 13F filing. Always interesting to see what Klarman's up to.
Exactly, he's a legendary value investor, and seeing where Baupost is putting its money can offer some real clues, about their thinking, maybe broader market trends too.
For sure. The goal today is really to unpack the main changes in their portfolio. It's valued at roughly $3.5 billion.
Yeah, $3,496,062,000 to be precise, across just 23 holdings.
Pretty concentrated. So those shifts, they really mean something. And there were some pretty notable ones this past quarter compared to Q4.
Okay, let's start at the top. Willis Towers Watson, WLTW, still the biggest holding.
Still number one, yeah. Valued at over $500 million, about $515 million.
But they did trim it, right, by about 17%.
They did. Cut about 311,000 shares. So they still hold over 1.5 million shares, but it's a noticeable reduction for their top position.
And just remind us, Willis Towers Watson is in risk management, insurance brokerage, that kind of thing. Human capital consulting, too.
That's right. It's a complex professional services firm.
So why trim the top holding, even though it's still massive for them?
Mm-hmm.
Is this just, like, taking some profits off the table, or maybe valuation concerns creeping in?
Could be either, honestly, or both. With value guys like Klarman, if a stock runs up and gets closer to what they think it's really worth, that margin of safety shrinks.
Right.
So trimming, even a core holding, makes sense. They're disciplined about not overpaying or holding things that have reached their price target.
Okay.
Doesn't mean they don't like the company anymore, necessarily.
Okay, that makes sense. Now, here's maybe the biggest surprise for me. Alphabet, GOOG.
Oh, yes. Huge increase there.
Huge, a 45% increase. They added over 650,000 shares. It's now their second largest holding, worth about $325 million.
Yeah, that's a major move into big tech, which isn't Klarman's usual hunting ground, historically speaking.
So what's the thinking? Why is Alphabet suddenly looking like a value play to Baupost? Is it the dominance in search, ads, cloud growth, AI?
It's probably a combination of all those things, I'd guess.
Mm-hmm.
They likely see that dominant market position, that wide economic moat, as very durable.
Mm-hmm.
And maybe they feel the market isn't fully appreciating the long-term growth potential from cloud, and especially AI relative to the current price. So it finally meets their strict value criteria, perhaps.
Interesting. So even tech giants can become value plays if the price is right and the future looks strong enough.
Seems like that's the bet here, a recognition of durable competitive advantages and potentially underestimated growth.
Okay, sticking with big increases. Wesco International, WCC, up 40%.
Another big one. They added almost 570,000 shares. It's now their third largest holding at over $311 million.
And Wesco is an industrial distributor, electrical, communications, utility stuff.
Exactly. They supply the essential bits and pieces for big projects.
So this feels like a bet on infrastructure, industrial spending, modernization.
I think that's exactly it. It points strongly towards a belief that we're going to see more spending in those areas. Government initiatives, maybe upgrading old facilities.
Right.
It's a classic kind of Klarman investment, in some ways tangible, essential goods and services, possibly undervalued relative to future needs.
Okay, now let's flip to the other side. The biggest reduction. Liberty Global, LBTYK.
Oof, yeah. That was a big cut. 37% reduction.
They sold nearly 15 million shares, still a large position at around $295 million, but a massive trim. What's the story there? They're mostly in European telecom, right?
Primarily, yes. And, well, cutting a position that significantly often signals some real concern.
Well, like what? Competition, regulation, growth prospects, maybe?
Could be any of those. The European telecom market is notoriously competitive. Plus, there are always regulatory hurdles and the constant need for huge capital investment, like for 5G and fiber.
So maybe Baupost just sees better risk-adjusted returns elsewhere, like in Wesco or Alphabet.
That's probably the calculus. Reallocating capital from an area where they see headwinds to areas where they see more opportunity. It tells you a lot about their relative conviction.
Okay, how about a completely new position? Fidelity National Information Services, FIS, jumps straight into the top 5.
Yeah, that's significant. A new stake worth about $261 million, around 3.5 million shares.
And FIS is a fintech company, tech solutions for banks, merchants.
Correct. Core processing, payment solutions, that sort of thing for the financial industry.
Buying that much of a new name right off the bat, That screams high conviction, doesn't it?
Absolutely. For a patient, value-focused shop like Baupost, deploying that kind of capital into something new means they likely see a really compelling opportunity.
What might that be? The business model, the sector.
Probably the business model. Strong recurring revenues, high switching costs for customers, which creates a kind of moat. Plus, the ongoing digital transformation in finance is a long-term tailwind. They must think the market is mispricing its value right now.
Gotcha. Let's keep moving down the list. Restaurant Brands International, QSR. Another substantial increase, 34%.
Yep, added nearly 1 million shares.
Mhm.
Now their sixth largest holding, worth about $259 million.
And that's Burger King, Tim Hortons, Popeyes,
Those are the main ones.
fast food. Seems a bit different. What's the value angle there?
Well, think about the franchise model.
Mm-hmm.
It generates pretty steady, predictable cash flow, which value investors like.
Ah, okay. Recurring revenue.
Exactly. Plus, these are strong, established brands.
Mm.
And businesses like this can be quite defensive, you know? They tend to hold up relatively okay even if the economy slows down.
So resilience and brand power at potentially the right price.
That would be my guess. A durable business model with defensive characteristics.
Okay, next up, CRH PLC. A slight increase here.
Just a small ad, about 53,000 shares. Still a significant holding at $237 million. They're a global player in building materials.
So this fits right back into that infrastructure theme we talked about with Wesco?
Precisely. It reinforces that bet. Even a small ad shows continued conviction in construction and infrastructure materials. CRH is a leader there.
Then there's Eagle Materials, EXP. This one had a huge percentage increase, didn't it? 42%.
It did. Added over 270,000 shares. Now worth over $200 million.
And they make cement, gypsum, wallboard, basic building blocks.
Yep. Again, heavily tied to construction, both residential and non-residential.
So Wesco, CRH, Eagle, it's a clear pattern, a strong belief in construction and infrastructure activity picking up.
It certainly looks that way. A multi-pronged bet on that sector, likely anticipating strong demand, maybe helped by government spending, and seeing value in these specific companies.
What about Dollar General, DG? A modest increase there, too.
Just a small bump, added about 44,000 shares, holding value around $185 million.
Discount retail, is that just a defensive play, hedging their bets a bit?
That seems like a reasonable interpretation. Dollar General serves a value-focused customer. That part of retail often performs better, or at least holds up, when consumers feel squeezed. So adding a bit there could be adding some ballast to the portfolio.
Makes sense. And lastly, Ferguson Enterprises, FERG, no change in shares.
Nope, held steady at 1.13 million shares, worth about $181 million.
And they distribute plumbing and HVAC supplies.
Right, so again, fits neatly into that construction and housing supply chain theme alongside CRH and Eagle Materials.
Yeah.
Holding steady shows continued belief in that sector exposure.
Okay, so we've gone through the major moves. If you had to boil it down, what are the key strategic takeaways from Baupost's Q1 activity?
Well, I think a few big themes emerged pretty clearly. First, there's this notable new interest, or maybe renewed interest, in specific tech and fintech names like Alphabet and FIS. Suggests they're finding value in digital infrastructure, perhaps.
Yeah, companies with moats and recurring revenue, even in tech.
Exactly. Second, there's that really strong emphasis on infrastructure and construction materials. The big buys in Wesco and Eagle, plus holding CRH and Ferguson. That looks like a high conviction bet.
Definitely feels like a major theme.
Third, you have the big reduction in Liberty Global. That signals perhaps a move away from European telecom, maybe due to concerns about competition or capital needs there, reallocating like we said.
Right, shifting capital.
And finally, there's a sort of selective approach to consumer stocks, increasing the bet on restaurant brands, adding a bit to Dollar General, focusing on strong brands and defensive qualities.
So tech, infrastructure, less telecom, selective consumer defensives. It paints a pretty clear picture of their current thinking.
I think so. It's a fascinating snapshot of how a very disciplined long-term value investor is navigating the current market. You see the principles, but also adaptation.
It really is. It gives you, the listener, a lot to think about regarding where a major player sees opportunities and potential risk across different sectors. Thanks so much for breaking all that down.
My pleasure. Always interesting to look through these filings.
And thank you all for tuning into Stock Talk. We hope this deep dive gave you some valuable perspective. Maybe consider how these big institutional moves might connect to broader economic trends and how that could inform your own view on things.
Good food for thought.
Absolutely. We'll catch you on the next deep dive.